Good afternoon, everyone. Sorry for this delay because of some technical issue. We are not able to start on time. I hope everyone be at home and taking care and not going out. So today's session is presented by Mr. Sandeep Baldeva. He's a partner and leader of Western region from Ernst and Young. He's led several forensic and FCPA, UKBA anti-corruption review engagement for large companies from USA, Asia, Europe, and Africa. He has conducted various training sessions on forensic accounting, white collar crime for enforcement agencies at central and state level in India, specialties specializing in forensic and fraud investigation, FCPA, UKBA, anti bribery, advocacy services, anti fraud controls review, fraud risk assessment, dispute advisory, competition law advisory. So today's session, our topic is insider trading regulation, covering latest changes done by SEBI. So I hand over to Mr. Sandeep Baldava.
Thanks, Jitendra. Thanks, Harish and Manaz, for organizing this session. Thanks, everyone, for joining this session. Irrespective of what scenario we are in, the regulations, continue to impact us. And this is one regulation which is a significant change from how it used to be earlier. And in the current environment, it is applicable more and more because people are operating from home, and there are different sets of information available with different sets of people, which could be considered as insider trading information. And what we would do is that we'll spend first 15-20 minutes going through some case laws and recent developments before we went into the theory, or before we dig into the theory of insider trading regulations. I would first take you through some case studies. If you have any questions, please send them over the chat box. So I have a couple of my colleagues who work with me in this area. So they are part of this session. So they will capture, and as soon as possible, we will respond to those queries during the session. And if you have any additional queries, I would take that at the end of the session so as to maintain the timing of the session. So if you look at from a development perspective over the last 1.5 to 2 years, almost every alternate day you find a news item on insider trading, and various steps being taken by SEBI to prevent insider trading as well as penalize people who are involved in insider trading. And this entire development started post SEBI discovered that there were certain WhatsApp groups which were operating, and their information with regard to financials of companies. When I say financials, primarily the revenue, EBITDA, and PAT details were being shared over these WhatsApp groups, wherein the information was available to certain journalists as well as analysts. That's when I think this entire process of reviewing the existing insider trading regulation was started, and SEBI did a fantastic job of revising the existing regulations. In fact, these regulations were revised in 2015, but in 2015, probably WhatsApp and other social media were not that active. So people started using more and more social media in the last 3-4 years. So that's the background in which the regulations were revised in end of 2018 and early 2019. So that's the background to this entire development. And if you look at it specifically, the case, there were multiple companies, but post investigations, SEBI determined that at least 10 companies were potentially found to have released. When I say companies, it's not the companies, it's probably individuals who had access to that information, released unpublished price sensitive information on certain WhatsApp groups that had analysts as well as journalists as members. Specifically in certain cases, 2017 June quarter financial results of these companies were leaked before they made public. In some cases, the information was leaked even before the directors or the board of directors had access to that information. So as per again the investigations carried out, the information that was shared through the groups was very similar, if not exactly similar, to the actual results which were published a day later or a couple of days later. So that triggered alarm bells across the system, and that led to the investigations that happened in these cases, and post that the changes that happened in the regulations. And if you look at the history of the insider trading regulations and insider trading issues, the violation of insider trading norms has been there for quite some time, and traditionally it was always difficult to pinpoint who exactly leaked the information, because people could do it over phone, people could do it in person, interaction. Company A employee can share information with company B employee can share with company A, and they need not trade in their own shares, but they can trade in the each other's shares. So there was no way available for either the company or the regulator to address those issues. And if we go back into Indian history, even in early 90s, there were cases. For example, in a famous case for a steel company, it was determined as part of the investigation that certain insiders who had knowledge of poor results which were to be declared in few days time, they went ahead and shorted the script of that entity, and avoided loss, and then in another case made profits because they did not hold any existing shares. In the second case, it's a financial services company which was also a very famous case in those days. Here wife of one of the managing director of the company was held guilty for selling the shares just before the company announced a huge loss. And the company's wholly owned subsidiary had declared a huge financial loss, which was to be incorporated as part of the listed company's financials. And before the results were released, the person as well as couple of companies associated with the person sold off the shares, and it was concluded that the managing director used unpublished price sensitive information and avoided loss, and he was found guilty and penalized along with his wife as well as the entities that were involved in this case. Then in not so distant past, promoter of a healthcare organization and certain connected entities were penalized for violating insider trading rules. In this case, the company was entering into a licensing and supply agreement with the customer, and before that became public, the family traded in the stocks of this company. In another case, a senior manager of a large listed company was penalized 7 million Indian rupees for trading shares of other organization and violating insider trading rules. In this case, it was a M&A transaction that was known, and it reached the stage where the company would go through the M&A transaction. At that stage, before the transaction was made public, the person shared that information with his broker, and broker traded in these shares, which led to a benefit to this individual. And SEBI imposed a penalty to recover the benefit as well as additional amount to disgorge the profits that were received. In the next case, belonging to another financial services company, senior management, a CXO level person, was penalized for trading in the script when in possession of UPSI, and he made a gain of 8.7 million Indian rupees. The investigation revealed that he was in possession of information with respect to sale transactions of certain group entities, which was almost finalized, but not revealed to the public at that stage. Then the sixth case is a famous case, which is a global case, and an Indian gentleman was also involved in this case. So in this case, a former director of a leading financial services company was convicted of insider trading. In this case, it was revealed that the director had allegedly illegally communicated corporate secrets with regard to a potential, investment and results to his friend and former hedge fund manager. So in this case, the director was permanently barred from serving as an officer or director of a public company in that country. And what is interesting in this case is that there was no direct evidence available, but SEC relied on a series of incidental or circumstantial evidence, which helped them crack this case, including the fact that a particular meeting happened at say 5 o'clock, and there is a call between the director and then the hedge fund manager at 5:1, and the hedge fund manager entered into a transaction at 5:05. While there was no specific evidence available to indicate what was discussed in the call between the director and the hedge fund manager at 5:1, but it was presumed that since the call happened immediately after the meeting, it was presumed that the trade that the hedge fund manager did was based on the insider information that he received from the director of the financial services company. And very recently, a very renowned investor in India is under probe by SEBI for alleged insider trading in the shares of a edtech company that is owned by this investor and this family. So if we look at it, traditionally, the insider trading cases have revolved around results of the company, and M&A transactions or potential investments that is supposed to happen, either a positive or a negative impact on the profitability. However, in the recent past, what we are seeing, and that's another major change in the current revised regulation, the insider information could be substantially wider than just the financial results and M&A and specific transactions. And we'll delve into that as we go into next slides in the next 10 minutes. Now, if you look at the data from SEBI's annual reports, we find that in financial year 19, the number of cases have gone up by 4 times, or almost 5 times compared to the previous year. That also shows two things. One, the regulation is having its impact. Second, whistleblowing in India has increased, which means whistleblowers are sharing information either with the company or with the regulator on potential insider trading that transactions that are happening. Especially after SEBI has come up with a whistleblower bounty, wherein any whistleblower who provides information on insider trading receives a reward up to 10 million Indian rupees or 1 crore Indian rupees. So the number of whistleblowers in this area has substantially increased, and that is also one of the reasons why the number of insider trading investigations have gone up in India. Today, the regulators have become more savvy and more smart, and they're also using social media as a tool for investigation and establishing evidence. Like the case that I described earlier in US belonging to the director of a financial services case, where a circumstantial evidence indicating interaction between the director and the hedge fund manager around the time of the board meeting was used as an evidence. SEBI in India has also started using social media links as evidence for proving that a person had potentially had insider trading information at the time of trade. In one particular case, again, this case is not in public domain, but whatever we learned based on our interaction with the industry sources. In one particular case, it was determined that an individual from the company was in touch with an analyst in Singapore, and the entity of that analyst traded in the shares of this company just a day before the results were to be announced. So it was presumed that those trades happened based on insider information. So the approach that the regulator is adopting today today is that if you have insider information, and if you and the designated person or the connected persons trade in those shares at that point in time, then it is presumed that the trade has happened based on insider information, irrespective of whether actually that trade has happened or not. So the onus of proving that the trade has happened without any insider information is on the insider rather than the regulator. So that's the biggest change that we see in the current regulation. So now if we look at some of the key changes in the regulations in December 18 and Jan 19 that happened, there is a great deal of focus on institutional responsibility. So earlier the responsibility was on the individual, and the surveillance used to happen based on the trading that is happening on the stock exchanges, plus the declarations that are submitted by the insiders, the then definition of the insiders to the compliance officer. But now the companies are required to implement and periodically review specific internal controls for prevention and tracking of insider trading. So that's one big change where the onus has moved from individual to the organization, including for implementing specific controls to prevent insider trading. This involves the company to implement a structured digital database that captures details of persons who receive UPSI at different points of time. And you also have to make sure that such digital database has an audit trail to capture who became insider when and what information was shared with whom at what point of time. Plus, we also noted that post this regulation, stock exchanges have randomly on sample basis started collecting PAN numbers of designated persons as identified by the companies to monitor trades by such individuals. So that's again a different and a new development where there is a proactive monitoring happening by the stock exchanges for trades being done by designated persons. Then the regulations also provide freedom to the board of directors to determine what is a legitimate purpose. But once you have determined what is a legitimate purpose, and once you have identified designated persons, then the regulations apply equally to all of them, and they need to comply with all the requirements under the new insider trading regulations. These mechanisms serve dual advantages. One, by aiding to trace a chain of connections while investigating insider trading, and also proving as a deterrent to insider trading. So this has been done to ensure that 90% of the people who might think of using insider information for improper trades are deterred from doing so. And second, if some people still try, which I think happens in all the scenarios and all the time, that few people keep trying to violate the rules that have been implemented. In those cases, there is a trail available to investigate and identify the source of leak, as well as the benefit that has been accrued, including the person who directly or indirectly benefited from that leak. Having said that, even today, and especially in the current environment, it is still very challenging to do a insider trading investigation because the ways and means through which you can share, say, a EBITDA, PAT, as well as revenue numbers are too many, and it need not leave any specific trail. But to the extent possible, regulator through various mechanisms, including making companies responsible for implementing these measures, is trying to ensure that as many cases of insider trading are captured, and there is a publicly kind of name and shame, including the penalties that are levied, which would deter more and more people from doing insider trading. Now, if you look at the definitions, again, it has been widely defined, unlike earlier where only certain people were covered. To give an example, while some of the initial ones were always covered earlier as well, but let's take example of divisional heads. Let's take example of support staff of the company. So when these investigations happened, the investigation agencies, including SEBI or the private investigators like us, what we discovered is that while the, let's say, the CXO was being covered as part of the insider trading compliance process, but the IT person who had access to that information, the executive assistant to the, let's say, the CFO or any other CXO, who also had information to exactly the same level as the designated person, they were not covered as part of this process. So what the regulation has done is that it has defined in a very broad sense who can be designated person. Now pretty much everybody, whether it is directly or indirectly, receives insider or unpublished price sensitive information at any given point of time, becomes a designated person. So that's a big change from what it used to be earlier. To give an example of how this covers different people, let's take an example of a pharma company. Now in pharma company, in the current environment, FDA inspection is an important process, and based on how the investigation went, as well as based on the report or the action that the FDA takes, the stock price can move either way substantially, and that has been proven in multiple cases in the recent past. The information normally is received by the quality team at the plant first, in terms of how did the investigation go, plus the letter is also received generally at the respective plant. So the person who is receiving this information, who may not have anything to do with all that is defined over here in terms of senior management, in terms of division head, in terms of support staff, etc., 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 is considered a designated person, because the person has now access to a confidential and unpublished price sensitive information, which can have an impact on the stock price of the company. Similarly, if you are an infrastructure company, and normally several infrastructure companies have defined a threshold that they would publish if they have won, say, order above 100 crores, and they would not publish smaller orders. But let's say it is determined by a person who is collating the data in terms of wins on the ground, that multiple projects of 15 crores each, totaling to, let's say, 150 crores, have been won by the company in the last week. Now that becomes unpublished price sensitive information, and that individual becomes a designated person, because he now has access to information which, taken together, can impact the share price of the company. So today, the definition of price sensitive information and the definition of designated person is very, very wide, and we must make sure that we understand this difference, we understand how this entire process works, and make sure that we implement it all at all levels, so that we are not missing out on the examples that I gave. And each industry will have such examples which are different than other industries. So we need to understand, besides the generic details and the generic names and designations that have been given as part of the regulation, which are captured on this slide, which other team members have access to sensitive information. So that's why these clauses are very important, where I think it defines in a broader way that all other persons being in any contractual, fiduciary, or employment relationship with the company, whether temporary or permanent, that allows such person directly or indirectly access to UPSI, or is reasonably expected to allow such access. So everybody who has direct or indirect access to UPSI is designated person under the new regulation. Now we look at the definition of connected person, so which is expansion of the designated person. It says any person who is or has, during the 6 months prior to the concerned act, been associated with a company directly or indirectly in any capacity, including by reason of frequent communication with his officers, or being in any contractual, fiduciary, or employment relationship, or being a director, officer, or employee of the company, or holds any person including a professional or business relationship between himself and the company, whether temporary or permanent, that allows such person directly or indirectly access to UPSI information or is reasonably expected to allow such access. Now this person is considered as connected person, and if we expand this further, without prejudice to the generality of the foregoing, which is the previous slide, the following persons will be deemed to be connected persons unless the person or the company establishes it otherwise. One, an immediate relative of the connected person. So the definition of immediate relative is also given under the law. Then a holding company or associate company or a subsidiary company or an intermediary as is specified in the section 12 of the Act, or an employee or director thereof. An investment company, trustee company, asset management company, or an employee or a director thereof, or an official of a stock exchange or of clearing house or corporation, or a member of a board of trustees of a mutual fund, or a member of board of directors of the asset management company of a mutual fund, or an employee thereof, a member of board of directors or an employee of a public financial institution as defined in section 272 of the Companies Act. This is to prevent bankers and then financial advisors from trading in UPSI, trading using UPSI. Then employee or official of a self-regulatory organization recognized or authorized by the board, and a banker of the company, or any concerned firm, trust, HUF, company, or AOP wherein a director of a company or his immediate relative or a banker has more than 10% of the holding interest. So the definition is so wide that almost everybody that is connected to the company, including a vendor or a third party service provider who has access to unpublished price sensitive information, becomes a connected person. Now if you look at the definition of UPSI, UPSI as per the regulation means relating to a company or a security directly or indirectly, that is not generally available information which upon becoming generally available is likely to materially affect the price of the securities and shall include without limitation, ordinarily including but not restricted to, information relating to the following: financial results, dividend, change in capital structure, mergers, demergers, acquisition, delisting, disposals, expansion of business, and such other transactions, changes in key managerial person. So if you look at this again, this broadly defines in terms of the financial results, divisions, capital structure, M&A transactions, and changes in key managerial personnel. But if you look at again the detailed commentary on this, it includes any information that can have a price impact, and it is sensitive enough to cause a fluctuation in the share price of the company either ways. Which could be a new contract, that is one, which could be a decision that we would exit a particular geography, which could be a decision around incident that has happened at a factory which may lead to a financial loss. For example, a large cyber attack that has happened, which can derail the operations of the company for a few days. So anything that has impact on the stock price of the company is UPSI. Then insider is a person who is a connected person and in possession of or having access to unpublished price sensitive information. Now if we summarize the key changes from a policy and procedure perspective, the companies are now required to make a dedicated policy for determination of legitimate purpose. They need to define what is a legitimate purpose. For example, with whom you will share financial information, with whom you will share information with regard to M&A, with whom you will share information with regard to let's say the results for the subsidiaries. So you need to clearly define what is a legitimate purpose and who has access to that information. That person is considered as insider, and all of them need to follow the insider trading policy of the company. Now insider trading policy is required to cover all designated person on the basis of their role and function, including promoters of the company. So there was a debate that was there between the industry and the regulator, asking for an exemption to be provided to the promoters of the company. But the regulator came back and said that there is no distinction that is being made. Anybody who has access to UPSI is a designated or a connected person, and they need to follow the regulation to the T. So promoters, directors, and of the material subsidiaries as well as fiduciaries, CEO and employees up to 2 levels below CEO, irrespective of their role and access to UPSI. So in this case, the CEO as well as 2 levels below, whether they have access to UPSI or not, they are covered as part of designated persons. Support staff, including IT and secretarial staff, having access to UPSI. Now, if you look at the impact that this will have on other policies, you need written policies and procedures for inquiry in case of leak of UPSI. If you learn that there is a potential leak that has happened, you learn either through a whistleblower, or if you learn through some information that is coming from the market, or some inquiry that is coming in from press or from the regulator, then you need to have a defined policy of who would conduct an inquiry, what information would be obtained for that, and who would access that report, and what action will be taken pursuant to that inquiry. Then whistleblower policy needs to be amended to enable employees to report leak of UPSI, which I think most companies would have done by now. Then there is a process that needs to be formulated for how and when people are brought inside on sensitive transaction, which means when you designate a person as an insider whenever they are part of any sensitive transactions. There is also a requirement of reporting of violations under the existing law, where the report of such violations by the designated persons and immediate relatives of designated person is required to be submitted to SEBI in a standardized format, that is Annexure A. Plus, the company is required to maintain a database of the violation of the code of conduct by the designated persons and their immediate relatives of designated persons that would entail initiation of appropriate action against them by the regulator. And there are already enough examples of these actions being taken, including in the case of some very prominent independent directors. Of course, they submitted that the trade has happened because of lack of their knowledge, and their portfolio managers undertook that trade, but still they were penalized, and as an example, they were asked to forego the profit that was generated through that transaction. Then in terms of process, the company is required to maintain, like I explained earlier, a digital database with trail of insiders with PAN numbers and proper internal controls, which means not too many people have access to that database and changes are not happening ad hoc. Plus, there is no process of deletion from that database, so it should be included and then tracked. Now, if a person who is an insider becomes a non-insider, then there is a process of removing that, but the original database should remain intact, so that if tomorrow some issue comes up against that person, then you know from which date to which date the person was a designated person. All the designated person by law are required to disclose the names, PAN numbers, mobile and phone numbers of immediate relatives, which are also defined, persons with material financial relationship, which means receipt of payment amounting to 25% of such designated person's annual income. So their names are also supposed to be disclosed to the company. The company is required to implement an adequate and effective system of internal controls to ensure compliance with the requirements of the new regulations, including identification of designated persons as well as what constitutes UPSI. Then all employees who have access to UPSI to be identified as designated persons. Restrictions on communications on or procurement of UPSI. We'll cover that in the next few slides, how that needs to happen. Then periodic process to review effectiveness of such controls and compliance with the regulations. So here the regulator is also asking that, okay, in the entire year, how many complaints that you are issued, how many gaps you are issued, How do you know that nothing is happening? How effective is the database? So they're also looking at the effectiveness of the entire process that is being implemented by the company. Now, what are some of the other key changes? First is trading by the insider. When a person who has traded in the securities, who at the time of trading was in possession of UPSI, then like I mentioned earlier, the trade would be presumed to have been motivated by the knowledge and awareness of such information in the person's possession. So in this case, it is you are proven guilty unless you prove otherwise. So that's the model that is being followed, and this is captured as part of the regulation itself, that there is underlying presumption that any trade that happens while in possession of insider information will be considered that it happened because of the presence of insider information, irrespective of the actual scenario in that case. The trading window has changed, so the trading restriction period can be made applicable from the end of every quarter till 48 hours after the declaration of financial results. And in the current environment, I'm sure you would have seen the news article which captured that if you are delaying your financial results, the trading window will start from 31st of March till, say, if you are declaring results on 30th of June. So the trading window will be closed till 2nd of July. So that's the requirement. I think there was a representation or a reference made towards this subject, saying that can we extend the start period from April 1 to maybe later, because most people are not publishing results. But I think regulator has as of now decided otherwise, because the understanding is that by now, while the results are not declared, but people have a clear idea about what those results will be, and most companies might release results in May, if not in April. So they would not want to change this regulation. So this is again a very important change, especially for insiders. The gap between clearance of accounts by audit committee and board meeting should be as narrow as possible, and preferably on the same day to avoid leakage of material information. In several cases now, companies have started doing these meetings post trading hours or on weekends as well, to avoid any impact of potential leak of insider information. Then there are certain trades that are exempted from insider trading regulations, which means off-market trades between insiders, two insiders who have access to the same UPSI. Then pledge of shares for a bona fide purpose, such as raising of funds, so that is allowed. Then the trades that are executed, undertaken, and pursuant to exercise of stock options at the predetermined exercise price, acquisition by conversion of warrants or debentures, then preferential allotment, open offer, delisting offer, etc. And finally, which is very important, is that sometimes people come back and ask us question that I, as an insider, technically then cannot trade in my shares at all, because by the time I complete the results for the previous quarter, the plan for the next quarter starts, and I might have access to insider information. But what the regulator has said is that you can have a trading plan, which is a predetermined plan approved by the compliance officer, and trades can happen based on that predetermined pre-approved plan, even during the trading window blackout period. So the trading window norms and restrictions on contra trade will not be applicable for trades carried out in accordance with the approved trading plan. So if you have an approved trading plan and the trades are happening based on that, then there is no problem, and there is no other way in which you can make trades during the blackout period. Now, if you look at current scenario, besides the traditional ways, today usage of social media is pretty high. Most people have WhatsApp groups, Telegram groups, now Teams, now Skype, various other groups where information is shared, and you just need three small numbers, which is the revenue number, EBITDA number, and PAT number, and you need not even document it. You can even just memorize those and then share. So in terms of, I think the difficulty in identifying and tracing insider trade is very high. However, in the current environment with the tools and techniques that are available, the probability that somebody gets caught in this entire process is very high when compared to say a couple of years back or 3 years back. Then transfer of data to external sources through various means, sometimes just to please, sometimes just to keep in good humor. Like in some companies, information was being shared with certain analysts so that they get slightly before others, and potentially maybe the understanding was that in those cases the analysts give a slightly more positive twist to the entire analyst report rather than just a negative twist. So there are different reasons why the information was shared, and which can still happen. So you need to be more vigilant in the current environment where social media is substantially used to share information. Then email shared to groups with members who are not designated persons. So when we did reviews for several organizations, some investigations, some as part of implementation of these programs and insider trading guidelines, we found that a lot of companies had these groups either for M&A transaction or for accounting or for consolidation or for taxation purposes. Now some team members moved out of those groups into other roles, but their email continued to be part of the same group, right? So technically what was happening is they were not being covered as part of the UPSI compliance process, but they had access to insider information. So you need to make sure that wherever you have group IDs, those are reviewed on a regular basis, and any change in that ID is happening is intimated immediately to the compliance officer, so that the relevant changes can be made in the list of designated persons. Then if you look at external sources, today what is happening is people are doing smart interviews, trying to extract information as potential employers or potential researchers, etc. So they are interacting with company employees in identified functions and departments and doing interviews to extract information, and they are putting two and two together to come up with a conclusion on what would be the potential scenario for a company, let's say in say a manufacturing industry. If they interact with the inventory guy, interact with a transport operator, and interact with couple of vendors and collect information, which can then lead them to a conclusion that potentially the company is doing great or not doing great. So that's another source of information leakage. Then analyst interaction we already discussed. Then also examples of phishing and malware attacks where people are asking information through alleged CEO mails, CFO mails, parent company mails, investor emails. So different methods in which people are extracting this information from gullible individuals. Now, what are the key challenges that we face when we try to implement UPSI guidelines and try to implement internal controls around UPSI guidelines? The first thing is lack of employee awareness and seriousness about the regulatory requirements. Still, I think you find that people are a bit casual about with whom they share information. Now in the current environment, this is an additional risk because most of the people are operating from home and probably operating from smaller houses in cities like Mumbai, where we may not have luxury to have a kind of a safe and a secure space to do interactions. Then absence of stringent controls to enforce the regulation, which I think is changing with the new changes that have happened. Mostly the activities are reactive. That is why the regulator has come up with a focus on preventive strategy than just reactive. Then there is a lack of stringent stance on a dissemination of UPSI. Like in some companies, directors ask the information 15 days in advance, but there is nobody in the company to go back and tell them that no, we can't provide because it will be difficult to maintain the track and ensure compliance. But now in the current environment, if you're going back and telling them that if you need this information 15 days in advance, then these are the procedures that you need to follow. They are coming back and saying that, okay, I don't need this in advance. So it's a question of how you communicate with the recipient, their responsibilities when they receive UPSI. That changes the manner in which they react and the manner in which they prevent leakage of inside information. Then lack of defined roles and identification of the designated person or key management personnel who are in possession of UPSI. I think we discussed the examples of IT staff, support staff, people who are doing consolidation, people who are just collating data for MIS purposes, etc. Then lack of policy framework. So now I think companies are required to implement a formal policy around this. Then finally, the social media exposure. So now if we look at COVID-19, I think we discussed this point a few minutes back, where the trading window will be closed for promoters and management from 1st of April till 48 hours after declaration of the quarterly results. And there is no change in the start date, which is April 1. So today in the current environment, what companies are doing is that taking additional measures. One, making sure that confidentiality is maintained. People are reminded about confidentiality on a regular basis. Then sharing of UPSI only with for legitimate purposes and only to designate individuals. If you are sharing it with external parties, it is done only via office emails and on their office IDs, so those can be tracked in terms of their usage. Plus, you are doing it after obtaining a declaration from their organization that either they have implemented a policy pursuant to UPSI regulations and they would comply with the additional requirements of UPSI regulations. Then each and every data that is shared with external parties needs to be updated in the database along with the trails with date and time stamp of sharing of that information, along with the details with details of with whom the information was shared. Then awareness amongst the people, especially promoters and management and designated persons, that the trading window is from April 1 to June 30 or until 48 hours from the declaration of results if the results are declared earlier. And also disabling where possible the printout options for the information that you share, so that people are not able to take printouts at home. And where feasible, store the data on a company cloud in a secure folder, and people have access to that secure folder through a password, but are not able to download the information to their personal device. Now, if we summarize what companies are doing, I think step one is improving the training and awareness, because that's the most important part. You can use the current time where people might have some time available to go through training on UPSI. So there is a standardized now module available, which you can incorporate as part of your LMS, and send them a training along with a quiz, so that they understand the importance of UPSI, especially in the current environment. Then you are implementing adequate measures for identification of UPSI, then identification of designated persons, maintaining the digital database of the designated person, then process of bringing in a new designated person who has access to the UPSI at a regular interval, so it's not a one-time exercise. Then implementing physical access controls, including entry access and control over printouts. Then system access controls, including encryption of data, like we discussed in the previous slide. So now, how does it work practically? Because it's all good to say that all of this we need to do, but how do we do this practically? So let's start with how do you identify UPSI? Because at a company level, a compliance officer alone may not be equipped to identify all designated persons. So you need to do a kind of a trainer session, and all the functional department heads and departmental SPOC from each team identify what is the UPSI in their department, and also who are the designated persons in that department, and any additional DP is there, then the SPOC communicates that back to the central compliance officer for UPSI. Sharing of financial information with auditors and audit committee. Make sure that it is shared only at the time of audit committee and not substantially prior. In some cases, they insist that they need to receive it a day in advance, which should be fine, provided you implement a kind of a cloud secured folder where they can have a look at the information but are not able to download and print that information. If the meeting, I think in the current environment it is difficult, but when the meeting is happening, you are doing it through a webcast. But subsequent to this scenario, when a printout or a tablet loaded with the information is shared, at that time, then you are ensuring that those documents are taken back and shredded or stored properly, and people are not carrying those documents. Really, if there is a time lag between the end of the meeting and declaration of results. Then board meeting is supposed to be conducted immediately after the clearance of accounts by audit committee and preferably during non-trading hours. The final financials are shared with designated team members of the statutory auditors only and not with everybody. Then audit teams cannot take any data outside the company or allocated company email ID and system, so that the review can happen at the premises. In the current environment where the reviews cannot happen at the premises, people are giving access through VPN and then tracking the use of that information through the VPN. So which means the data is still not moving to the auditor system, remaining with the company. Whatever analysis the auditor needs to perform is being performed at the designated folder and stored in the designated folder. The final working papers are then being sent by the company SPOC, audit SPOC, to the auditor over email. So that's the process that companies are following. Then in terms of internal controls, having a separate workspace with secured access for teams working on preparing financials and other UPSI. Then doing a bug scan of the secured area is undertaken to see if some bugs are there, both in terms of physical as well as people trying to extract information from the computers. Then post closure financial accounting system access is restricted, and it is accessed only by senior members of the FNA team on a need to know basis. In fact, some companies have also implemented a process wherein a dummy entry is passed by the CFO, and that entry is known only to the CFO, and only just before the audit committee that entry is reversed, so that no one, including the auditors, have access to the exact number before the audit committee meeting. So that's another method that some companies have used to make sure that the exact data to the last decimal is not available even with the auditors just before the audit committee meeting, which means 98% of the procedures can happen, because an audit doesn't have anything to do with the actual numbers, whether it is higher or lower. They need to report the numbers as they are and audit the numbers as they are, so that one entry can be audited later and numbers can change later. So that's the methodology that some companies are following. Then restricting usage of mobile phones, including WhatsApp usage for official communication. This needs to be formally followed. Then other data leakage prevention controls are implemented, including DLP, so that you have a track of who accessed what, especially for people who have access to UPSI. Then internal policies across functions are suitably amended to access data and exercise controls, which means your employment contract, your IT security policy, your HR policy. So what I was emphasizing is that you might have to revisit your employment contract, your data privacy policy, your investigation policy, and your IT security policy to allow the company access to the devices of employees which are used to access the company provided information. So that is very important if you want to carry out an investigation tomorrow for any leak. Then the digital database, which is configured to send automated emails and intimation and notice to the proposed designated persons every quarter or at every sort of incident that needs to be considered as potential reportable incident. then that is linked to HR database to pull in available details required in the digital database, so there is no duplications. Then trading details can be obtained by the compliance officer from the registrar and transfer agent, and compare that with the details disclosed by the designated persons. You can perform a link analysis for abnormal trading patterns observed during the trading window closure. You need to sensitize DPs and fiduciaries on a more regular basis. Make sure that there is a training happening and kind of a reminder through regular obtaining of compliance confirmations. Some companies are doing it on a quarterly basis, some companies are doing it on a half-yearly, annual basis, but at the minimum on an annual basis you need to do a refresher course, and people need to sign off on that refresher course, as well as the compliance certificate that they need to provide that they have not knowingly violated any of the UPSI policies of the company. So then implement a code of fair disclosure, which means legitimate purpose will include sharing of UPSI in ordinary course of business by an insider with the partners, legal advisors, auditors, insolvency professionals, or other advisor and consultant. But you need to send a notice to such persons to maintain confidentiality. Now, one question that keeps coming up in our interaction with the industry is that let's say if there are 25 people working from a particular organization, let's say audit firm, consulting firm, or a credit rating firm, whether all the people needs to be sent notice to. Normally, if you have a clear policy and clear confirmation from the respective organization that they have implemented UPSI, and all the people they have implemented UPSI policies, and all the people who work on this project would go through the same level of compliance as any insider, then that confirmation is enough, instead of going through this process with each individual that works on that engagement, provided that the organization confirms that they are taking care of the compliance. Then in terms of the guidance, you need to provide guidance to your team that interacts with analysts and investors. Then press releases, release of annual reports, quarterly reports, company literature, then analyst meetings, investor bankers and broker sponsored conferences and road shows. Also earnings guidance to the markets. Several companies have stopped doing that, but whoever is doing it, they need to have a specific guidance that should be part of the policy with regard to do's and don'ts when they undertake any of these activities. Now I move to last section of our session, wherein we'll capture some myths versus realities and then discuss what is the role of audit committee as well as internal auditor in implementing and monitoring these policies. One of the myths or questions that keep coming up is designated persons refers only to senior management employees. However, the new definition under the PIT regulations 2018-19, it covers all officers and employees of the company up to 2 levels below the CEO, VC, MD, DMD, whatever you call, irrespective of their functional role in the company or ability to have access to UPSI or not. The second myth is it refers to only employees of the company. No, it covers any connected persons and all individuals in possession of or having access to UPSI directly or indirectly. So besides employees, it could be employees' families, it could be third parties who are working with you, including vendors, customers, consultants, advisors, auditors. All those are covered as part of insiders. Then trading window restriction is applicable only to employees. No, it's applicable to all the designated persons and insiders. Only the management and promoters trading activity are being monitored. The reality is that all designated persons and insiders trading activities being monitored by the company, by stock exchanges, and by the regulator. So now if we understand what is the role of the board of directors and audit committee, so based on, I think, again, the regulation as well as various, I think, interactions that have happened, broadly what the regulator expects from the board of directors and audit committee is that they will ensure that a formal code of conduct to regulate, monitor and report trading by the designated persons and immediate relative of designated person is implemented, and that helps in achieving compliance with these new regulations. They are responsible for ensuring that the management makes a policy for determination of legitimate purposes, which is approved by the board. So in all these cases, the management is supposed to do it, but the final approval is required from the board of directors or audit committee. Then the management maintains a structured database like we discussed earlier. Then in consultation with the compliance officer, specify the designated persons to be covered by the code of conduct on the basis of their role and function in the organization and access to UPSI. Then on a periodic basis, review compliance with provisions of the regulations at least once in a financial year, and shall verify that the systems for internal control are adequate and are operating effectively. Then formulate written policies and procedures for inquiry in case of leak of UPSI or suspected leak of UPSI, and accordingly initiate appropriate inquiries on becoming aware of UPSI and inform the board, which means inform the company board, then ultimately SEBI also is referred as board, promptly of such leaks, inquiries and results of such inquiries. So now if you look at it, the board of directors have the direct responsibility for implementing and monitoring the compliance with these regulations. However, in reality, they would expect the management as well as internal auditor to help in this entire process. So how can internal auditor play a role? To start with, the internal auditor can review the existing insider trading policies and internal guidelines pertaining to UPSI, and then benchmark them with the new SEBI regulations and then the subsequent clarifications that have come up. Then reviewing the existing processes, internal controls and practices relevant to UPSI regulations, which means how the designated and connected persons are being identified, whether the database is complete, not complete, what are the controls over the database, both in terms of IT controls as well as physical controls. Then effective communication of UPSI by the designated persons, is that happening, not happening. Then list of activities to be periodically monitored by the company, such as monitoring of trades by the designated and connected persons. So is that happening or not happening? So these activities, actual activities, will be done by the compliance person identified for this activity, but internal auditor is expected to go back and review the compliance with the policies as well as effectiveness of the internal controls and procedures that have been implemented. Then the internal auditor can also look at the controls relating to maintaining Chinese walls and information technology, such as restricting the physical access, CCTV surveillance, restricted usage of social sites and external devices, and identify if there is any potential abnormal pattern that they see when they analyze the logs for these different areas. Then also look at the company's existing policies and maybe benchmark them with the global best practices in addition to the SEBI regulations. Having said that, I can fairly with good confidence tell you that the Indian regulations are so wide that if we adopt them itself, those are, I think, good enough from an international benchmarking perspective. Then help the company and the compliance officer create awareness by conducting workshop and training programs on this topic. So here we end our session, and I'm happy to take any questions. I hope my colleagues would have answered some of the questions that you had, but I'm happy to take more questions because we have enough time to take questions.
Hello.
Yeah.
Yeah. Thank you, Sandeep, for this today's session. Actually, there are some questions actually requested by the attendee. So, shall I take one by one question?
Yeah, please.
Okay. So, the first question actually I saw is the statutory auditor is also a designated person.
Yes.
Okay. Uh, Once the designated person identify, for how long the regulator will monitor the activity of designated person?
No, the process is, it's a continuous process. Like, for example, an auditor, the way I think the rules apply to auditors are in fact more stringent, because they are not supposed to trade in the company shares at any given point of time, not just during the trading period. So it's a more conservative approach for auditors. Similarly, for the designated persons, the process applies from the time they have access to UPSI information. So it is nothing to do with a particular defined time threshold, but it is more to do with the time from when they have insider information.
Uh, there is a one question actually. They're saying, what's the revised guideline for insider trading? Actually, I think we are today we are talking the same thing only, but still I find there is a question in there. What is the revised guideline for insider trading?
The revised guideline is what we discussed today. So this guideline came into effect from 1st April 2019
Okay,
and applies to all listed companies. So those are the changes that we discussed today.
today. Okay. How can insider trading be applied in case of IPO?
In case of
IPO.
IPO, I think the process applies once the company is listed. But if there is a information, I think I don't know how that process works in terms of the gray market, transactions that happen before the IPO. But when a company is going for IPO, the rules will apply from day one, which means before the stock is listed, you should have implemented all these policies and procedures. Let's take an example that the stock is listed on say 10th of April, and you have access to information which indicates that the results of the company, which will be declared say on 15th of April, would not be that good, but the IPO listing happens at a premium. Then you would trade in that share, taking that inside information advantage. So from a IPO point of view, you are supposed to implement the insider trading regulation before you hit the IPO, because the rules apply from day one. And if you are not implemented, then you may be in violation of the regulations.
Another question is, how can one track the leakage of UPSI in case of IPO?
That depends on the nature of information. So if you have implemented the procedure in advance, and you have the designated persons identified, then you are supposed to implement those procedures from the time it is decided that you would go for IPO, or when the DRHP is approved by the regulator. So from that point onwards, you need to implement the same measures as you would implement as a listed company, because from that point onwards, people will have access to information which may be considered UPSI.
Okay. The another question is, the intraday trading of share is also covered under insider trading.
Any trading is covered.
Any trading.
Insider, FNO, everything is covered.
Okay. Does structured database means separate system? Can the compliance officer approve sales through mail when the separate system is already existing? So
You
first
can
question is,
approve or email.
sorry,
Yeah,
yeah,
yeah.
please continue.
So in terms of the database, yes, it has to be a separate database with limited access and audit trail being maintained. Second, in terms of approval, yes, it can be approved over email, but the challenge is if the number of people who are asking for these, approvals are too many and it's happening at a regular basis, it becomes a difficult process to track. The regulator has not defined that it has to be only through a kind of a ERP or a similar, system. What the regulator says, that you need to implement a system which is robust, which is has an audit trail and can be audited.
There is a one more question related to the intraday trading. How does intraday trading can be tracked?
The company cannot track it, but in the investigative process, the stock exchange has been able to pull that information and provide to the regulator. I think the only people who have access to that information is the stock exchange. It is not available with the company, It is not available with the RTA as well because it is intraday. So that information is not available with the RTA as well. So that is available only with the stock exchange. And there have been examples where it has been called out from the stock exchange and then taken as part of the investigation.
Okay. Whether client can share the screenshot on designated internal audit email ID to evidence the query raised by the client.
No, not sure what kind of query that is.
Yeah, I also means whether client can share the screenshot on designated internal audit email ID to evidence the query raised by the client. No, I'm also not understand the question. Okay, we can skip this for the timing. Yeah, these are the questions for today's. Uh, yeah, thanks Sandeep for today's this important session. For as an internal auditor, definitely it is one of the very informative and key session today, because this is one of the new areas that internal auditor also definitely need to see, and it's one of the very important area looking to the key changes happening recently. And thanks all participants for today's session. Thank you very much for all, and please take care all of you. Don't go outside and take care of yourself and all your family members. Yeah, Sandeep, you want to say
Thanks again,
something
Mehnaz.
closing?
No. Thanks to you, Mehnaz and Harish, for organizing this session. I hope people find it interesting. If you have more queries, my email ID is given here. Plus, if you want my mobile number, that is also available in public domain. Please feel free to reach out for your queries.
Thank you, sir.
Stay safe and take care. Thank you.
Thank you.
Thank you.
Bye.
Bye everyone.